When the market makers got positive gamma, we already can understand that they generally, as a rule, sell higher prices and buy lower prices, hence the reason why we get rotational markets, right? So positive gamma is rotational markets. It's not bullish and it's not bearish. It's rotational. Negative gamma is bullish trend or bearish trend. So when we see the call options in the ascendancy, we are saying to ourselves, okay, well, we've got a positive gamma environment just here, right? So we've got a positive gamma environment here. But obviously, as the put options start developing upside, that positive gamma could start getting wiped out quite considerably. We could start seeing that positive gamma getting wiped out because of the surge in put options. Why would the surge in put options wipe out the positive gamma? Because what do the market makers predominantly do with put options? Do they buy them or do they sell them? What do market makers predominantly do with put options? Do they buy them or sell them? They sell put options. So therefore, a surge in put options, Murray, will obviously make the gamma far more negative. So we can start watching for surges in put option volumes, which is the orange line. We can start watching for surges in put option volumes that reduce the positive gamma. Now, obviously, this chart isn't going to really tell us a lot except for the big macro position of gamma. So the big macro position on gamma just now is still pretty strongly positive. But obviously, that amount of gamma changes over time, doesn't it? The amount of physical gamma changes over time. So what do we do about that? Well, of course, we can get rid of this chart here and replace it by the call options as a relationship to the put options. This is what the chart looks like. So in other words, if that goes higher, that means that positive gamma is getting higher. And when it goes down, it tells us that the positive gamma is getting less. In other words, there's a few more negative gammas coming in. So it becomes more applicable to trading that we see some negative gammas coming in, that selling coming in at this point here or selling coming in at this point here could become a proposition that we want to lean against. We could start using that as some sort of way into the sell side of the marketplace. If I look at equities during those periods, we can see that that turn there is an equity top edge, and this turn lower here was also selling coming into equities, which resulted in this drop in equities, exactly in line with that gamma trade. Exactly in line with that gamma trade. Now, obviously, if we look at the call volumes, this is the call volumes against the put volumes on indexes. If we just look at the SPX, which is one of the biggest institutional indexes, the picture is subtly different. We can take a look at the SPX call volumes, put volumes, and we can see that this picture is subtly different. It kind of went negative right the way through this process. It's not really doing very much from the open, but you can see that this went kind of negative from the gun here, and you can see that it's never really recovered any of that positivity. So obviously equity selling into top edges beyond this point becomes possible, but obviously until this one changes as well, you know, we've got to balance these out. We've got to try and balance these out. That's why I like the index information, because it's a little bit more timely. So we can see that index, we can see that this phase here has declining positive gammas. Declining positive gammas is bearish equities, bearish neutral equities. Increasing positive gammas is obviously neutral bullish. Declining and negative gammas is very bearish because it's getting more negative as the price drops. And that's going to bring more delta selling and more gamma selling at lower prices. So we've got to put that into context with a big picture. If this number is still pretty high, and the calls are still ahead of the puts, which they are, as you can see when we just look back at that chart, we can verify that it is still in a positive gamma environment. We can see quite clearly that it's still in a positive gamma environment. Well, that means that it's not a dangerous trade at the bottom edges. It's getting more dangerous, but it's not a dangerous trade. And because of that, there's a very good chance that the specs might not have any particular interest in this trade, right? So when we look at the S&P, for example, and then we look at the specs who are obviously trading the volatility curve, the surface of the volatilities, we can see that they're not actually that bothered about this so far because of so much positive gamma. It's getting worse. So I'd expect to see these guys starting to catch up with equities a little bit, but it's not the kind of environment that these guys are going to start panicking in any time soon at this point, because they have so much positive gamma that a drop in equities doesn't concern them. They don't really have any desire to necessarily hedge, but any dramatic changes to that could bring a lot of very, very aggressive selling. Now, in some respects, I disagree with the specialists today for some very obvious reasons. Two of the more common indicators that we talk about are the quality spreads and the banker trades. Take a look at the quality spreads and the banker trades, guys. What do you recognize by today's business? Does anybody see a change in the quality spread and the banker trades? Yeah, it's pretty obvious, right? Into the top edge, we can see from the cash open that the quality spread has had no upside at all. It's not even budged off the bottom edge yet. The quality spread is actually declining since the whole move higher. However, the market trade, the banker bets, were pretty positive still at that stage. They were still at least sloping up, right? Still at least sloping up. However, into this top edge, the banker bets now join in with the quality spread traders. And you can see that the banker bets and the quality spread traders are now bearish at the same time. And you can see this enormous surge of volumes, which starts the top edge process of selling, which is stunning trade off the highs. 26s down to 12s. Into the low price, you can see there's not a lot of banker sellers coming in. The quality spread's bearish, but it's not getting any more bearish at this stage. So obviously we're going to be watching for down here for possible bids coming in the background. There's a couple of nice little levels to think about. And remember, our gamma levels, 10 and 11s, right? So this is our gamma level right here. So this is where that gamma is going to be likely to be defended by people like the specs and all those other guys in the dealing desks. They're likely to try and defend this price. So you should be watching for bids at that point, guys, yeah? So what I'm saying is, Cliff, that in a positive gamma environment, the specs don't mean as much. In a negative gamma environment, the specs should be all over the trade before it even happens, yeah? So a lot of people say, well, when can we rely mostly on the specs to be right in a negative gamma environment? Because that's when they're really sensitive to volatility hedging, right? When a negative gamma environment, it's all about volatilities. In a positive gamma environment, it's not about volatilities, is it? It's not really that important to the specs because they've got positive gammas. They don't have to hedge out volatility narratives. I think Casey, we'll get started maybe in a couple of minutes if you're still in the room, so we can get you guys finished up.